today we have the honor of welcoming a very distinguished academic, but who is also a very distinguished, policymaker. And it's great that he could join us, Professor Panicos Demetriades. He has the unusual advantage of combining a high caliber research contribution intellectually over so many years, at the same time has had the fantastic exposure of being able to work as a central bank governor in Cyprus during the time when his contribution was very much required to be able to resolve issues in the global financial crisis. So, Panicos served as governor of Central Bank of Cyprus during 2012 and 2014. And he's published extensively in the most prestigious journals you can think of, possibly traversed most of the journals in financial economics, banking, finance, economics. He's also the author of 2 path-breaking books. One is a must-read. It's called A Diary of the Euro Crisis in Cyprus, Lessons for Bank Recovery and Resolution. And my first read of that book made sure that I treasure it so much. There is also another book that came out last year from Columbia University Press called Central Bank Independence and the Future of the Euro. And both of these books are drawing from his exceptional policy insights from the Euro crisis. Also, he is also a distinguished fellowship, elected as a fellow of the Academy of Social Sciences in the UK in 2011, and 2019 became the trustee of the Money Macrofinance Society here in the UK, which seeks the advancement of the field in monetary economics, macroeconomics, and financial economics. So has very good fellowship and academy. And as you can see on his CV, he's very proud to indicate that was born in Limassol, Cyprus, and so has traversed quite a number of countries, of course, and has a PhD in economics from the University of Cambridge. Okay, so we are honored to welcome you, Panicos. The floor is yours, and you can speak maybe maximum 1 hour or less, depending on how much. But you speak at leisure, and then we shall be able to take up some of the questions after your presentation, given the nature of the platform we are using today. Thank you very much. We're honored to have you here.
Well, thank you, Victor, for your very kind and generous introduction. I feel really humbled, and I hope I'm not going to let you down after you set the expectations so high. This paper is a short paper. It's already published in Economics Letters, so I don't think I will take 1 hour to present it. I probably, I think I can do that in probably just over half an hour, in fact, at most, and then I would very much welcome comments. I've been working in this literature for very many years, as you sort of pointed out, since the early 1990s. So it's a very, very long time. And I've seen the literature change from the very early days when there was a group of World Bank economists. And in fact, let me welcome also the audience. I didn't say anything about the audience. I'm really honored and humbled that there's such a diverse audience from all over the world. So this is the advantage of seminars during the pandemic. We have become in one community, although we are not able to be physically together. But I think this has broadened basically the audiences and the interaction. So it's a great thing. It's a great feeling. So going back to this literature, I do remember the very early days when I was a young academic trying to make my mark on the world, and I was just sort of reading the literature by the leading authors, and in those days it was King and Levine, the very famous paper, Quarterly Journal of Economics, I think 1993 it was, and it was just the finance growth paper, and it was basically doing cross-country growth regressions and sticking in financial development in it and showing that actually financial development in 1960 could help predict, they argued, growth in the next 3 decades. So there you have it. All you needed to do was just increase your financial deepening, and you could actually help promote economic growth in the next 3 decades. It was very appealing as a policy prescription for most poor countries, all developing countries, middle-income countries, for everyone, basically. There was no exceptions. Just do it, and you'll be better off. More finance, more growth was one of the sequels of Ross. And I met Ross Levine. He was also young and making an impact on the literature. But there was a group of World Bank economists at the time, and they pushed that agenda really, really hard, right? And it became a literature in its own right, finance growth. And in my early stages, when I took those papers, I was working back then with Philip Arestis. And we thought, my goodness, where is the causality in all this, right? This is all cross-country growth regressions. How can they just conclude, make such strong conclusions from just some cross-country growth regressions? And we started doing sort of sensitivity tests, and they were falling apart, I can tell you, with the easiest sensitivity tests. You could just add a few countries or subtract a few countries. It was very sensitive, basically. It was really very, very sensitive to the sample. It was sensitive to a lot of things. But you couldn't publish a paper common in the QJE, and I tried, forget it. Eventually, I did manage with my very first PhD student, Khalid Hussein, who now works for the United Nations in Addis Ababa, the Economic Commission on Africa. He's got a great job, and I went and visited him a couple of years ago. And Khalid was in his early years of his PhD, and I said to him, look, we've got to really do some proper causality tests for this finance growth. And I got him to work on it, and he did produce some great results. We put them in a paper, and Khalid said, let's send it to World Development. And I said, oh no, it's a great journal, World Development. I don't have nothing against it, but we should aim at the very top. And he was like, Panicos, you're not serious. JDE, I said. Panicos, you're not serious, he said to me. Well, I'm a young academic. I need to make my mark on the literature. So let's go for it. So reluctantly, he agreed. We sent it to the JDE. Believe it or not, we got the revisory submit. Very extensive revisory submit. They made us work very, very, very hard. Very serious, very thorough, and in fact, those revisions improved the paper. And that paper came out in 1996 in the JDE, and it is my most cited paper. It's got over 2,000 citations now on Google Scholar. So Khalid was, of course, over the moon. He got a lectureship at Kent out of it, and eventually he joined the United Nations, and he is happy. But that paper, basically, what it did was to challenge the cross-country regressions, and we used time series analysis to show that we used 25 countries. We couldn't get data on more countries. If you start using time series data, the causality is just simply not there. More often than not, you find reverse causality, so it's growth that leads finance. Sometimes we find bidirectional, and in many times you don't find anything. So we felt that it was excessive, and that sort of paved the way for my later contributions in the literature to try and understand its relationship better. And a lot of my later contributions was like questioning and saying that you need to quality adjust somehow. You need to look at regulation. You need to look at institutions. And actually, when financial development is embedded in good institutions, there's a paper there with another PhD student of mine, Siom Kuk Lau, who is at the University of Putra, Malaysia, full professor now. And he's done a lot of great work after me. You know, he's published in top journals, great guy. We basically showed that institutions matter for the financial development. Then a lot of work sort of was on financial fragility. And this is where actually working as a central bank governor during the crisis really helped shape the way I'm looking at things and future research. But this is sort of like as a background to this paper. And what this paper does, oh, sorry, I'm not, no, what am I doing? I'm just, yeah, second, this is the second slide. I hope you can all see it. So what does this paper do in a nutshell? Well, in a nutshell, basically it starts from the very later finance growth literature, post-GFC, and there's now a lot of literature saying that, ooh, you can have too much finance. The finance growth nexus can be reversed. Finance can be deleterious for growth, right? Oh, what's happened? My presentation ended, it says. Someone else has started sharing. Ooh. I don't know what happened.
I think someone else has accidentally clicked to take control.
Oh.
And they're trying to, yeah. So.
I mean, I can continue to talk. So basically, it's post GFC. There have been papers questioning that there was ever a finance growth nexus, right? Or that maybe we have reached too much finance, right? And the most famous paper is published in the Journal of Economic Growth 2015 by Arcand et al. And Ugo Baniza and someone else, and basically saying that actually when finance exceeds 100% of GDP, you go into negative territory, right? So that's what motivated. I don't believe in this sort of extreme sort of results, going from one end to another. And I do believe in this subtle quality adjusted financial development. So what we do in a nutshell here, we use financial fragility indicators, 3 of them, the Z-score, a measure of liquidity, and a measure of impaired loans, non-performing loans, to construct quality adjusted measures of private credit to GDP. And that private credit to GDP is the most popular development in this, indicator in this literature that people have used. And miraculously, lo and behold, we uncover the nexus. That's all you need to do. So basically, quality adjusted financial development matters, has a positive relationship with financial development. And we basically bundle financial development with this inverse of financial fragility indicators to create just a neat, simple way of interpreting things. Because in some of the research, earlier research, we're putting it separately, and then the meaning gets lost. So you have a financial development indicator that's dirty, and then you add financial fragility, and then people want to know, well, what is the net effect? And you can't answer it. So this is what we did here to find the net effect, right? And of course, because this was part of Victor's wider agenda, we also tried to see whether these results hold in Sub-Saharan Africa. This was very, very important. And we show that the results hold, although we couldn't get a big enough sample to pass it through the most rigorous econometric tests. But I think that could remain for further research. But at least in terms of the lighter econometric tests that we put the sample to, those results hold, right? And of course, Sub-Saharan Africa is a region where we want finance to make a difference, right? And you know, if it can't make a difference, then we should really do what's necessary to build it, to strengthen it, to make it more resilient, to make sure that it does its positive contribution to growth, because that could mean a lot of people out of poverty, basically. Okay, that's the paper in a nutshell. So I'll take you through the paper bits by bits now. Oh, I need to take control. Yeah. Okay. Yeah. Thank you. Yeah. Can do that. So I'm not navigating. So this is a kind of this is something I've already mentioned, but let's look at the literature. I think Rousseau and Wachtel, Peter Rousseau is one of my co-authors also, but they are the first to basically show that the finance growth nexus has weakened. They said it has weakened. They didn't say it's reversed, but that's a paper in Economic Inquiry 2011. So And I think that their data, probably most of it predates the global financial crisis. But they did introduce some banking dummies in some of the equations, and they were able to recover the finance growth nexus. So if you can avoid having a crisis, then finance growth nexus, they said, is still there, right? As long as you avoid having a crisis. So that's their result. So it's pretty similar to ours, but we'd like to think we're taking the argument a little bit further. The paper that I mentioned earlier is the Arcand et al. Paper, which is in the Journal of Economic Growth, and they do show that financial debt starts having a negative effect on output growth when credit to the private sector reaches 100% of GDP. They say that this is consistent with the vanishing effect of financial debt, and their results are not driven by endogeneity, output volatility, banking crisis, low institutional quality, or by differences in bank regulation and supervision. It's, I mean, clearly a good paper. It's published in a top journal, but I just find this sort of results, you know, over 100% is bad, below 100% is good. This threshold result, I think it should be taken with a pinch of salt. I'm not going to try and diminish it, but I just do think that it's hard to just say that all finance over and above 100% is bad and below it is good. I find it so hard to believe, and I just can't imagine policymakers taking this seriously, frankly, right? This is where I'm coming from. Maybe it is robust, maybe they show robustness in econometric terms, but I just can't see why you could you know just turn negative just after 100% of GDP. I think if you can't have a large banking system and the finance growth relationship can be strong if that banking system is well regulated and the banking system is resilient. So it's not about 100%. I think that's my gut feeling. But I think importantly, if you take, say, Sub-Saharan Africa, all the countries will be below 100% of GDP anyway, right? If you take a lot of middle-income countries, again, they would be below 100% of GDP. And another good paper in this literature is a paper by Sama Gandhi, 2015, I think it's Journal of Banking and Finance, and they used middle-income countries, and they used data from 1980 to 2008, and they find this relationship, there's a inverted U-shaped relationship in middle-income countries, right? So again, it's the idea of too much finance over a threshold. So okay, so what do we do in our paper? So what is the data that we use? Well, we got all the data that it could get. So it's 102 countries, 1998 to 2017. So we have the GFC, the global financial crisis, in the sample, right? And other crises, obviously, from 1998 to 2017, right? Our financial and macroeconomic aggregates are standard. They are from the World Development Indicators. And the financial fragility data is from the Global Financial Development Database of the World Bank. And that is what restricts the sample to 102 countries, is because it's not available for everyone. Now I have the summary statistics in table 1, and then the model is outlined in equation 1, is the benchmark model, which is the starting point is just a fixed effects regression, right, in which we set the lag dependent variable to 0, right? So we're using basically all the data that we have on an annual basis. So dependent variable is GDP per capita growth in country I. We do have the lagged variable there, right? But we drop it for the fixed effect regressions. Then we have financial development indicator, right? Then a bunch, this is a vector of control variables. And we use our preferred measure is financial deepening, is private credit to GDP, okay? So the control variables are the sort of standard control variables that people have used in this literature. Now you might ask the most important question: how did you adjust? right? Did you do something sophisticated? The referee thought we did something very sophisticated, but we didn't. It's very simple, actually. We just multiplied, right? We took the private credit to GDP and we multiplied by one of the three indicators. You might say, why don't you do it separately, basically? If it's logs, right, you just have the variables separately, and then you control for if the variables have the same coefficient. I just wanted a simple, clean, simple explanation. Does this work or not? And it works, right? One of three indicators, the Z-score, right? Okay. So the Z-score is how far away you are from bankruptcy. So it's how resilient you are, right? It's basically measured with profits, right? Profits, your current profits relative to I believe your assets, or but I mean the exact definition is obviously later in the paper. The second one is liquidity. Is how liquid is your banking system, and liquidity is not everything, but clearly a liquid banking system tends to be a healthy banking system. But my preferred one is 1 minus the ratio of impaired loans to gross loans. So right, it's good loans, good credit, basically. You have a lot of bad credit in the system, then you may have a lot of, private credit to GDP, but if it's bad credit, you don't expect it to be good. Of course, you might say it's endogenous, right? This is endogenous. Of course, everything is endogenous in this world, and we try and do all the econometric tests to control for that sort of endogeneity. But we can think of, in terms of how we think of it, how I think of it as sound banking practices, right? So this adjusted indicator reflects sound banking. And there's different ways to capture sound banking. One is profitability. If you are profitable, obviously you can set aside more capital, right? And your capital buffers can absorb the losses, right? If you're not profitable, it's maybe because actually you're setting aside a lot of capital to cover those impaired loans, right? And if you are liquid, obviously it's because people trust you, right? That's why you're liquid. Depositors trust you, and that tends to be you sound, right? And then credit quality is just you don't have many non-performing loans. Your credit is good, and you're screening, you're monitoring, you're looking at the borrowers properly. It's a well-functioning banking system that loan origination and all the rest that goes with the banking side of things is of good quality, right? So these are the data definitions that I was looking for earlier. So Z-score measures the number of standard deviations the return on assets needs to fall to wipe out bank capital. So it's in relation to bank capital, right? This is return on assets and how many standard deviations you need to fall. So if your return on assets is high, then that score is high. Right? Liquidity is ratio of liquid assets to customer deposits and short-term funding. And then non-performing loans, the ratio of gross loans it's the ratio of impaired loans to gross loans in percent. Then the other variables are schooling, standard, and then trade openness, and then inflation rates. Oh, and then we also have government spending as a control, and population growth, right? Okay, so these are our summary statistics. Growth per capita, private credit, Z-score, liquidity, NPLs, schooling openness, inflation, government spending, population growth. So these are our variables, okay? And our summary statistics. They kind of seem reasonable to me. Okay, and then preferred estimation method. Well, we do use our preferred estimation method deals with endogeneity. So it's this dynamic panel data model using system GMM. It's the Blandel and Bond estimator. And okay, it's not perfect, but it does allow you to instrument all explanatory variables using the internal instruments, and we ensure that the number of instruments does not exceed the number of cross sections. So here we refer to my other co-author, Badi Baltaji, and still colleague, a part-time colleague at the University of Leicester, Buddy. So our estimates include country-specific effects, time-fixed effects. Okay, so I start with the fixed effects regressions. Okay, there's column 1 is the standard finance growth regression. So private credit is unadjusted, pure and raw private credit. And what do we find? Negative and highly significant. So basically, we to some extent agree to the finance growth nexus has reversed. It's not about threshold, it has actually reversed. If you take the whole sample, it has reversed. If you just take data up to recently, right? Okay, so this is finance growth nexus finished basically regression, right? 30 years later, at the end of my career. At the beginning of my career, this coefficient was positive, you know, robust. We had lots of arguments how big it was or was it significant. At the end of my career, it turns negative, right? This is almost like a Lucas critique to the entire literature, right, on finance and growth. We spend our entire life, you know, working on this. How many people? Thousands of people. I mean, there are thousands of finance growth paper. I'm sure Victor knows them, and a lot of people in the audience, I'm sure, are familiar. I'm sure some of you wrote papers like that. But there it is. If you do a regression with the latest data, it's just not there. It's negative, actually, right? But look at that. Go to the first regression. And this is quality adjusted private credit. And what is the credit measure? Z-score. It goes from negative to positive, right? All you need to do is just take that, multiply with the Z-score, and you uncover the finance growth nexus, right? It's just miraculous, basically. And you go from 3 asterisks negative significant to 3 asterisks positive significant. Of course, this is a fixed effects regression, right? There may be endogeneity there, right? And we accept that. And that's why you need to show the other regressions later. But other than that, everything else remains okay, other controls, etc. How about the other indicators? Very similar results. This is the liquidity indicator, again, positive, significant, just 2 stars. So it's, and then my preferred indicator, which is impaired loans, is positive, significant, 3 asterisks, right? Okay, so very large sample. So, I mean, you can compare this to the original, if you like, finance growth King and Levin regressions. You can uncover that. I mean, they didn't care. Well, they didn't demonstrate endogeneity, exogeneity back then. If you are prepared to do a King and Levin regression, you can actually uncover the finance growth nexus just simply by quality adjusting private credit. What are these? This is Sub-Saharan Africa, right? 5 to 8 is the sample. It's much smaller sample, only 16 countries, I'm afraid, right? That's all we could get data on. But still, it is nice to see that the result is there for 2 of the 3 indicators, right? If you put the finance growth, this is a standard regression, right? Just the pure standard unadjusted. You get positive, but not significant. And this may, to some extent, reflect this threshold effect, right? These countries are well below the threshold, right? To some extent, because I don't quite believe in the strict thresholds. But these countries, you don't see the negative effect, the deleterious effect of finance on growth, but you don't see a positive significant either. So it's very small, positive coefficient, not significant. Lo and behold, adjust for quality becomes positive, right? And highly significant, Z-score, right? Liquidity doesn't work. I have a story for that. We know of African banking systems are highly liquid, and a lot of them just place that liquidity in France or in West African countries, put in France. I think the other countries put it somewhere else, right? They are liquid. Liquidity is not necessarily an indicator of resilience or of, you know, finance helping growth. So maybe that's why liquidity is not a good variable there. But definitely the other variable, impaired loans, does work. It doesn't work as well as the Z score, but it's still significant, right? At the 5% level, right? So loan quality works. So you are getting the result, you are uncovering the finance growth nexus. Okay. So the next table looks at, well, provides the dynamic panel regressions. Now we are controlling for lag growth. We're doing system GMM, and are doing the same analysis, right? We can't do the same analysis, however, for the African countries. It's just simply too small a sample. So we do it just for the whole sample, right? And surprising, or not surprisingly, perhaps, well, the first thing is that the lag-dependent variable is actually highly significant. Private credit in the first regression highlights significant and negative. So this is reproducing the fixed effect result, basically. It's still there. Nothing much else is significant, but private credit is negative and significant. When you quality adjust, you get the positive and significant result again, 0.262, 3 asterisks, right, with the Z score, right? Schooling is the only variable that shows some significance here. Okay. Liquidity, just 1 star, so just 10% significance. And the same is true of my preferred variable, impaired loans. But I think we can sort of, well, I hope we can agree that there is here some evidence that even after you control for possible endogeneity, that the quality adjusted results go through. So we'd like to think that we can, at this very macro aggregate level, we have uncovered the finance growth nexus as long as we use quality adjusted indicators of financial development, which may be endogenous, right? Of course, financial development itself could be endogenous, but in this case, at least, we have done as much as we could in this data to control for that possible endogeneity. Okay. Now, what's the economic significance of the findings? Well, I think these are trying to get some numbers out of this. Long run estimates suggest the standard deviation increase in private credit may depress economic growth by approximately 0.9 standard deviations. Quality adjusted private credit is positive and statistically significant in columns 2 to 4, although it's only at the 10% level in the final 2 columns. And then, well, the results suggest in the long run, standard deviation increase in quality adjusted private credit may increase economic growth by almost 0.4 standard deviations on average. I think that's quite large, quite significant. It's not enormous, but it's not, you know, we can't say it's the end of the finance growth nexus, basically. We want to believe that it's still there, as long as the banking systems are healthy, are resilient. So what's the implication for policymakers here? We think, and we see that in Europe a lot, but also in other countries, and I see that through my work for the IMF, that policymakers, particularly central banks, should persevere with efforts to clean bank balance sheets, to reduce those non-performing loans, so to free banks from the NPLs, but also to make sure they don't arise in the first place, right? It's not just cleaning bank balance sheets, but also it's loan origination strategies. Make sure that the banks are assessing borrowers sensibly and follow good sort of procedures to identify the good from the bad borrowers. Okay, and well, our findings also suggest that exploring the quality adjusted financial development indicators is promising avenue for future research. I don't think in this short paper we have all the answers, right? And you can, of course, I'm sure you will have comments on the econometric procedures, on ways to do it better, and I'm sure there are many ways to do it better, right? I'm not claiming this will change the world in terms of finance growth, but I like to think that this opens a new avenue for research. Like my original paper with Khalid Hussein, that got published in the JDE at the very early stages of my own career, when you know, a lot of people obviously were influenced. If it has 2,000 citations, and they thought it's a good way to look at finance and growth. I hope this paper also opens some avenues for other researchers to use these indicators, right? And in more sophisticated econometric contexts, using different econometric methods, using different samples, etc., etc. You don't have to use system GMM. You can go back to cross-country growth regressions, to averages, to other methods. But I think it's worthwhile using those indicators, right? And actually bundling them, you know, having them as sort of an indicator of good credit, if you like, right? It makes the interpretation so much easier. So I don't know how I done with time. It's just 40 minutes, I think, right? Or even less. It's a short paper, as I said. Clearly convinced the referees to go into economics letters and the editor, and they didn't really ask for many changes, very, very few, in fact. So I'm really delighted and pleased that because I think economics letters does, people read it, it's short papers. And in this day and age, we don't need very long papers. We need to get our contribution out in simple terms and with some punchlines. And the highlights they force you to put in actually are very, very helpful, I think, for researchers and, you know, for everyone, because you really need, instead of writing long stories, you need to kind of have punchlines, right? This is what people like this day and age, right? My students like that. Also, I hope some of them have joined. I encourage them to come today, because I was actually by pure chance teaching on the same right topic to my master's students this week. So I said to them, why don't you join? I hope some of them have joined. I'm not sure though. I don't know. Thank you very much for listening.
Thank you so much, Panicos. Very profound presentation. There is so much in that paper, and that's why economic letters go for where there is, you know, greatest contribution that can be summed up, you know, compactly. Definitely, this departure from a work that has been accumulated over the years. It's also great that you told the story of the area work in this area. I think, you know, over the years, you've made a tremendous contribution to this literature. And in this particular paper, I think your innovation of by looking for, you know, quality adjusted indicators and then being able to tease out the relationships systematically was, you know, very profound. And you are a very good storyteller, so you've been able to deliver the message from hard econometrics in such a simple way that is absolutely convincing. You know, thanks very much. Let me also take this opportunity to acknowledge a number of people that have come from all over the world to join us, and you know, some of those also, you know, old friends of mine and old friends of Panicos. I could see Jonathan Kipiri from the Bank of Zambia, Kuru Intel from Cardiff, Peter Rose, Seychelles, Bojo, Sweden, Godfrey Charles, I think, Leicester as well, Osman Watara from Manchester, Mr. Kibona from Tanzania High Commission, Mr. Mukela Mutukwa from Zambia High Commission, and then Oscar Dazi from practitioner from Guarantee Trust Bank in Ghana. Thank you very much for being, all of you. And maybe there are some more whom I've been able to see for being able to join us. So now we are going into the discussion. And let me thank all those people that have been able to, you know, go into the chat. Not many comments there. So maybe I could see, yes, a show of hands from people who'd like to comment. So I'll first go with an old PhD student of yours, Panicos. who is producing very fantastic work, has taken a cue from you, Panicos. Prolific, highly prolific. Aisha Demir.
Hi, Panicos. Thank you very much for this insightful presentation. And my question is basically on the quality adjusted measure of private credit. As far as I'm aware, that you multiply private credit with 3 measures, Z-score, and the 2 other measures. I was wondering why you didn't interpret this as an interaction term. Rather, you create another measurement where you multiply both indicators, but you didn't interpret them as...
Yeah, I mean, as Victor
why you
said,
didn't go for this way? Yeah.
Yes, Aisha, thank you very much. It's a very good comment, right? We could have. It is an interaction term, right? It is an interaction term.
Yes, it is an interaction term.
Yeah, it is. You're absolutely right. But I like storytelling, as Victor says, right? And I like to say this is a quality adjusted indicator of financial development rather than just an interaction term. It's just the spin I'm putting on it, right? Because if I say an interaction term, people say, oh, it's an interaction term. It's different. I think it gives it much more weight. It makes it more policy relevant. I'm saying it's good credit that matters, and I'm saying it doesn't quite really, it works with different indicators. Somebody might find another indicator. So basically what I'm trying to say is the health of the banking system that matters. I mean, you may measure it like this, you may measure it like that, you may interact like this or like that. It shouldn't make that much of a difference. What you want is strong, healthy, resilient banking systems. And I feel that with this interpretation, it is easier to have the punchline. If I say interaction, people start thinking, what interaction, what? And then they also start thinking and they ask you, why don't you put them separately and check if the coefficients are equal? I just don't want to do that. I don't want to do that because my message is this. I want to have a message for policymakers, if you like, which is pure and simple. And I want to also have a message for researchers to say that actually interaction terms, yeah, in econometric terms, they have a specific meaning. But if you want an economic interpretation, just, you don't need to insist it's an interaction term. I mean, it's just me. I mean, I may be wrong, right? Maybe it's easier to connect to researchers if you say it's an interaction term. But I didn't want to say it is an interaction term, which it is. I mean, So you're right. It's a good comment. Thank you.
Thank you, Panicos.
Thank you, Aisha, and thank you, Panicos, for the response, and also thank you for acknowledging the funding. This work is part of a large research project done here at SOAS, University of London, and Panicos has made an important contribution to it. Hongbo. Yes, Hong, I can see your hand up. And then after that, I'll go to Pascari. Hong, can you unmute? Yeah, sure.
Yeah. Thank you very much. I enjoyed that, even though small, but it is very clear. And I have a similar question, actually, as the previous one. I think the interactive term actually matters in 2 ways. First of all, in terms of the economics, actually, you bring in the institutional or the quality, i.e. institutional factor into the growth model. However, we did not see a separate institutional indicator in the growth model to control the impact of the direct impact of this institutional factor. So to me, yes, if it is an interactive term, not only statistically, we should have the 2 separate terms as the control and to isolate the impact of the interaction between the quality and the credit and the financial system. So that's 2 things, statistically and also economically. I see we would like to see the institutional economics impact is also controlled in the growth model. So my second question actually concerns the so-called conventional relationship. It's not conventional, it's the second stage of this literature, i.e. when the economy is reaching some kind of a threshold, then the relationship is negative. However, I'm very confused about the underlying mechanisms. So why financing should be very good for African countries in the first instance. They need money. However, why does the relationship between financing or financial development and growth becomes negative? When, for example, you said when we use the most recent data to check this.
Thank you. Yeah.
Very good questions, obviously. I mean, on the interaction term, yes, of course, I'm guilty as charged. But I think that this is where I think this paper, I like to think it opens avenues. Think of it, other people can take this now and say, if we do this with the interaction terms separately, we can enrich basically what we have found, and I would welcome that, right? I've done it myself in other papers, right? And then I think what the difficulty is, it's difficult to then get the simple economic significance of the result, because you have two variables, right? And you say, how do you get the combined effect of those two variables? I like to say this is a proxy. This is my economic interpretation. It's a proxy for the healthiness of the banking system. Yes, it is an interaction term, and you may want to look at it from that point of view, right? As an interaction term rather than a proxy. I'm saying it's a proxy, and that's my interpretation because I just like it. I think it's simpler for policymakers to work with the idea that a healthy banking system is actually good for growth, rather than private credit has negative effects on growth when sort of and the Z-score sort of can mitigate that, right? And then at some point, at some thresholds, it goes over. It's more sophisticated, that I take it, and I would welcome others doing it, right? Do the sort of interactions and see because you will find the threshold, right? This is where you will uncover the threshold for the Z-score, and then the threshold for the impaired loans could be somewhere else, and then you try and get a meaning out of that. And I'm sure some people can do that meaning. I've seen papers, my own papers actually. I was working with Johan and with others, and it's just so much harder to get a simple, clear message out. So I like this paper because it's a simple, clear message. Now with the negative effect, why is there a negative effect? When you look at it at the macro level, right? I think what has happened is that a lot of banking systems over that period have deteriorated in terms of health, right? They have deteriorated in terms of non-performing loans. They have deteriorated in terms of profitability, and they have undergone banking crisis, right? But banking crisis is not the only thing. It's also, you can actually avoid having a banking crisis. I have another paper actually, which is much longer, with like 15 papers, where we conclude that, and that's with Johan and with Peter Rousseau. It's very recent. It's not published yet. It's also part of the same project. And it's much harder because the message is so much more complicated, if you like. You've got to work with all these thresholds, basically. So the idea is that financial development, banking systems have become, over time, sicker, right? Less healthy, right? And that is exactly why, if you don't control and you don't condition for something else, the overall relationship becomes negative, right? Right? And of course, it could be different for different countries, but we throw everything in the wash in these cross-country macro regressions, right? So it's everything together. So it's just the average effect. I'm sure that if you can do, and as we have done, and we have uncovered that, you start controlling, you put the raw indicator in there of private credit. You can then add banking crisis, dummies. Then you can add financial fragility indicators. Each of these variables is significant, right? And you can begin to uncover positive effects from private credit once you condition, you don't have a banking crisis, and you're not too much in the territory of financial fragility, because you can actually avoid a banking crisis, but your banking system could still be sick, very sick. You think of Japan for a long time, right? They had a sick banking system, but because the government was standing behind it, saying, I will, no bank will go bust, basically. People were not worried. The system was liquid, but profitability was very low, right? And NPLs were very high. It wasn't really helping growth. A system like that cannot help economic growth. You can control for all these things, right? And then you can have a message, and you did have a message, and people don't understand it, right? You put it on the abstract, you try and explain it clearly. If you avoid having a banking crisis, and if your financial fragility indicator is below a certain threshold, and it will be a different threshold for different variables, then you can actually uncover the finance growth relationship. People look at you like this. I've been through referees, a lot of referees. The paper has been turned down quite a few times. It's much richer, much more sophisticated, but yet the message is not simple, is not clear. But I welcome others. Maybe I'm not doing it very well. Maybe me and my co-authors can't really get that right. But I welcome others working on this, and it is promising avenue for future research. But thank you very much for your comment. It's a very good comment.
Thank you. And thank you very much.
Thank you, Hong, and thank you, Panicos, for that response. Now I have Pasquale.
Hello, hi, Panicos. Hi, it's very good to see you again. And thank you very much for your presentation, for your talk. It's a very interesting seminar, very interesting paper. I very much liked especially your finding on the reversal of sign when you consider the more specific indicators, and you correct for the quality of the services provided by the financial system. I have a short question on the econometrics that I think builds a little on what has already been asked by Asha and Hong. And you have already partly answered this question, and certainly you have addressed this issue in your many papers on the topic. Is whether in the context of this approach you have explored more systematically the possibility of heterogeneity in the sample and possibly structural breaks that could be either across the countries in your sample or over time. And you have mentioned that there has been a deterioration in the profitability of a number of banking institutions that might have been responsible for the negative sign on the raw measure that you first used. So just to ask you whether you have done some specific analysis of structural breaks in the context of your sample. I have also some questions that are broader, that do not pertain specifically to this to this paper. And one is that there is a huge theoretical literature on finance and growth, and I would just like to have a brief, your brief comments, your brief views on the scope of this literature and the direction it has taken, because there's been a lot of debate on whether finances has a positive or negative effect on growth, and the use of resources absorbed by the financial system, cream skimming, Patrick Bolton and others. So just your views, if I may, on the theoretical literature on finance and growth. And the second question is, in your paper you find a role for the quality of loans provided by banks, and I was wondering whether you are concerned about the deterioration in the structure of loans following the current pandemic and COVID. I've seen a recent report by the Group of 30 edited by Mario Draghi and others, where they are concerned about the large increase in non-performing loans during the pandemic, and they suggest a number of possible measures that the banking sector could possibly take. So yes, I was wondering what are your views about non-performing loans in the context of the current crisis. Thank you.
Yeah. Okay. Well, thank you very much, Pasquale, for your very sort of detailed and extensive and thought-provoking comments, I would say, and questions. I'm not sure I'll be able to answer them very well, because they're very deep, and probably some of them require a lot of new research to be answered. Now, the short answer to the structural breaks question, I think that we are controlling for the econometric side, at least, we are controlling. You have country dummies, and we also have time specific dummies. So at least econometrically, I don't think we are too worried about it, because econometrically, I think the method sort of should be dealing with that. So it shouldn't really alter the qualitative nature of the results. Now that there may have been structural breaks, clearly they're certainly a possibility. I can think of different ways of approaching this topic, you know, before and after the GFC, for example. Then you can split it in different groups, but ultimately, when you want to do this sort of cross-country analysis, you really want to have as many observations as possible. And I think one advantage of using the dynamic GMM is that it gives you more observations, right? Because you use every annual observation there, right? Instead of sort of averaging out. And then you also use the entire cross-country dimension. But certainly there are other ways you can go about looking at structural breaks. What has changed? I mean, in economic terms, I mean, a lot of things have changed. And I mean, the global financial crisis, of course, it was a big shock to the financial system of developed countries, for sure. The bank's health has deteriorated in many countries in the developed world. We have looked, actually, we've done, because we had a big ESRC project on financial fragility, which we looked at this, and we have other papers in which we looked at which countries have done better, which are worse, and etc. And I do remember, actually, that Africa comes quite high in terms of NPLs, right? It was coming up as one of the worst regions. Another region is the Central and Eastern Europe, was coming pretty bad. In fact, that worried the EBRD a lot, right? That's why they were going into sort of different forms of finance for them, right? But I think in general, things have deteriorated in Europe. Maybe in the US they managed to fix their banking system, but in Europe, Central and Eastern Europe also, in Africa, these indicators are sort of have deteriorated, and that's why you are seeing the negative relationship in the aggregate data. Now, on the theoretical literature, well, I'm not a theoretical economist. I don't know what to add to this or what to say to this. I'm often disheartened and perplexed and worried that economic theorists talk among themselves and they just go into more and more esoteric stuff. That's all I can say, that I wish they interact more with policymakers, with more applied economists, because ultimately, you know, you can be publishing in the most elegant theoretical papers in the top journals, and few people read them, and that's very. I'm sure that's very disheartening. Although they may get, you know, the most reputable, prestigious chairs in the top universities. I think that's a comment for economics in general. Actually, we need to be relevant. We need to be to have an impact. Otherwise, we are in danger of becoming the less and less they call it the dismal science, and they have a reason, and they are becoming less and less relevant. I've sat on the governing council of the ECB with Mario Draghi, as you mentioned for their last comment, and I do remember, without naming names, every time a Nobel Prize winner sends something about the, how to solve the euro crisis, some of them say, oh, Greece should leave and come back 10 years later, or things like that. People just completely perplexed, right? Just sit there and, you think that the same people you admire so much as academics, they're not making any sense when it comes to policy, right? Very sad for economics as a whole. So I have a little bit of a negative view on that. Although the models are elegant and you look at them, they're beautiful, you just try and put them in practice. And I've worked with theorists, and I consider some of my best papers I've done partly theoretical. I had a theorist like Spiros Bukias of Nottingham, and then testing the theory. It's wonderful. Svetlana, some of my work with her, which is wonderful if you can just do this sort of work. Well, it's really, really hard. And then it's also, you get the referees, the theorists would not like the empirics, or the theorists may not like the theory. It's just a nightmare when you try and marry the two, actually. But some of my best papers, I'll say that are like that. Now, the pandemic. Yes, of course. I mean, it would be surprising if the pandemic didn't really have an impact on bank balance sheets. What are the answers to that? I mean, it's very hard. I think governments should continue. My view is that fiscal policy should continue to be expansionary. Governments should borrow and help the private sector as much as possible, because if they don't, then in 1, 2, 3 years later, we may start having banks failing, right? Because banks are doing, well, there's a lot of regulatory forbearance at the minute, right? And that's the right approach in the middle of a crisis. But when you're coming out of it, those bad loans could come back to haunt us and could really cause the banking crisis. So I think the government should not worry about debt to GDP ratios at the minute, public debt to GDP, I mean, and should be helping the private sector as much as possible. You can't help, of course, companies that are going to fail. They were weak in the first place. So, I mean, I haven't seen numbers yet, but I am worried going forward that banking systems are going to suffer a lot. So as much help by not just governments, but also multinational organizations, international organizations, the World Bank, the IMF, the ECB is doing as much as it can. I mean, it's quite amazing what they're doing, the Fed, etc. So I think a lot of support to banking systems and to the private sector, which will basically minimize or mitigate the problem for the banks, is really called for. I don't know if I've answered your questions. I tried. They were tough questions, but thank you for asking them, Pasquale.
No, thanks, Panicos, I think, for the response, and thank you, Pasquale, for introducing this discussion and heightening the debate. Absolutely, your response is also very helpful, Panicos, and I think all the observations you made are relevant here. We'll be hearing more from Pasquale definitely in the next seminar. May I call upon Dr. Peter Arroz, has his hand up. Please unmute and make your intervention.
Thank you so much, Professor Murinde, and thank you so much, Professor Panicos. It's good job. I admire your level of enthusiasm with regards to the Z-score. But my questions to you is that even the Z-score, when you are computing the variables, could reach 3 level, the safe gray zone and a distress zone. And all these Z-scores can be influenced by policymakers at different point in time of the economic cycle. What I mean by that, it could be a recession, during a recession, it could be a stagnation, and it could be a boom period. Did you test for this cycle, economic cycle, bearing in mind that policy making changes over time with the cycle zones? Thank you.
Well, thank you very much for your question. It's a very good question. Yeah, of course, the Z-score does change, and you know, the economic cycle will have an impact on the Z-score. There's absolutely no doubt about that. How we control for that in the econometrics, I mean, if I can find the equation. Well, okay, so the cycle is captured through the lag-dependent variable, right? So the lag-dependent variable is actually positive and significant in the dynamic GMM regressions. The Z-score itself obviously would be impacted, and any endogeneity, we believe, well, to a large extent, is captured by the econometric method. So, in terms of yeah, the Z-score is important. The Z-score can go very low and can go high, and it is impacted by the economic cycle. But I believe that method that we have used does really control for any possible endogeneity, as well as the business cycle, the effects of the business cycle in the estimations. So that is my answer. But it's a very good point, obviously, in terms of the economic analysis of the Z-score, and of course in a longer paper. This is just a very short paper, so we can't do much policy analysis. One can actually take the Z-score and put it through simulations and see what the impact is on growth through this sort of model, right?
Thank you very much. Thanks, Peter, and thanks, Panicos, for that response. I don't see. I'm trying to look for any hands up. Who'd like to? Let me check in the chat room. Okay, and back. The show of hands. Maybe these comments and discussion really a very rich discussion, and thanks, Panicos, for giving detailed answers to all these questions. I think one interesting aspect came from a number of people commenting. First of all, ignited by Aisha in trying to look into this construction of the new variable versus an interaction. And then later on, the observation by Pascali on what is happening on the theory. And just to go back to think about people who have contributed to this area, for example, Paul Roma's work on endogenous growth. Another impressive work, I think, on endogenous growth has been Philip Agion. And, both of them do not take so much interest into the finance angle, finance dimension of endogenous growth. The interesting thing would be, though, about perhaps the transmission mechanism, okay, that maybe how finance impacts growth may not be so direct. There has to kind of be transmission mechanism. Maybe that's where theory would play, an important role. As we advance more towards looking at, say, new initiatives like, fintech, new forms of finance, how do we be able to capture the transmission mechanism? I'm also asking this because I see in the audience we've been fortunate to receive high-level policymakers from the embassies of Zambia, Tanzania, and others who may be interested in the policy dimension and say, okay, how does it work? Is it a direct impact that you finance? You have quarterly adjustment in finance, and then you get growth the other way around, or is it there has to be something in between there that serves as the transmission mechanism? Again, these are some of the kind of ideas people have conversation about. I don't know whether you want to add your insight on this, Panicos. Yeah.
Okay. Let me just sort of, in very simple terms, I like to think of, if you like, an AK type model, right? Y equals AK. That's the simplest form of endogenous growth. And you can introduce financial intermediation in that growth. That now this again is a theoretical discussion, but I will come to the policy implications in a minute. So how can finance impact on growth in the AK model? I mean, in the AK model, you can have growth continuously as long as capital accumulation exceeds the rate of population growth and the rate of depreciation, right? So if you accumulate more than that, then you have endless continuing growth. You might ask, is this AK model a good model for growth? I would say if you interpret capital broadly, it's not just physical capital, but also intellectual capital, human capital, then it's not a bad approximation, just in very broad terms. So how does finance? Well, there are three channels through which finance can affect growth in this endogenous growth context. One is saving mobilization, right? Saving mobilization is something that this finance growth literature has been talking about since the days of McKinnon and Shaw. How do you encourage saving mobilization? But one thing for me as a policymaker now, coming into it, I'd say trust in your financial system is what drives savings mobilization, right? What drives trust in the financial system? It's good regulation, sound banking practices, right? So I'm connecting now to my paper, right?
Yeah.
That's saving, that's one. Number two, the efficiency of financial intermediation. You could have a banking system that is good, sound, resilient, but is very highly inefficient. In the process of financial intermediation, it absorbs a lot of resources. If it absorbs a lot of resources, then the resources that can go into capital accumulation are a lot less. So you want the financial system to be healthy and resilient, but you also want it to be efficient, right? Okay, so it's the X efficiency. You don't want to overpay bankers, to give them loads of bonuses. And we know, of course, that those distort incentives, right? You want also your banking system to have sound practices in place to influence the average productivity of capital, because that capital A in the AK model is the average productivity of capital, right? How do you do that? Well, the standard banking system is through through loan origination, monitoring, screening and monitoring, getting the right borrowers, making sure you address the problems of adverse selection and moral hazard in the credit market. And we have papers on that in the Oxford Bulletin of Economic and Statistics that actually have both theory and empirics. And they are on why do African banks not lend enough? And there we have an analysis of the credit market. It's not a growth model. It's just a pure analysis of borrowers and banks' actions, right? And then we put that to the test. There's also empirical work there. But actually understanding the workings of the credit market, you really have to go inside the box, right? You have to become micro now. From macro level, you have to go to the micro level and understand the functioning of banks, understand the functioning of credit markets, and try and remove the frictions, try and improve them. There's a lot of infrastructure that goes there, and it's not just regulation, and it's also good governance, right? It's how even your credit risk committee works in a bank. And this is what supervisors should be doing, to making sure that the credit risk committee is diverse. You can't just have, one everyone thinking the same, one size fits all. you can't have the same people. You've got to have diversity. You've got to have, in fact, this paper is showing that you've got to have women and men, and with different ages, different backgrounds, right? A supervisor should be able to do that, right? Your risk committee, your audit committee, good governance in banks so that loan origination really is good quality, right? And if loan origination is good quality, then that average productivity of capital is going to be higher. So I don't know if I'm answering these questions, but
you are absolutely, yeah.
I'm going, I am, you can work from simple theory. You can look at the problem at the macro level, but then you can go to the micro level and look at what things need to be done to fix things. And in fact, that's why I love my work for the IMF, because I do go to countries, I have been, and sadly it has stopped, through as an advisor basically it's advisory work to central banks, how to make the central banks themselves become more efficient, if you like, but also indirectly how to help them get banking supervision and get banks to become healthier, right? So it all starts obviously from the supervisor, and usually it is the central bank in most developing countries, right? So you start there. You've got to get the central bank, first of all. You've got to get the legal framework of the central bank, the governance of the central bank, and then the central bank, the banking supervision department to be right. And then they're going to be doing the right job with the banks themselves, right? And there's a lot of work going on. And I had the pleasure as governor, actually, to do directives, revamp directives, wonderful work, for loan origination, loan restructurings, because also you get the problems, right? How do you clean up the banking systems, right? You've got to make sure the banks have in place the right processes and procedures that create trust, but also help them to get rid of the bad loans, right? Through restructurings. They have to sit together with the borrowers. They have to basically assess whether the borrower is viable or not. If it's not viable, they've got to do the foreclosure. You've got to have the laws right for foreclosure procedures, right? Because otherwise, if the laws don't work, then it's one tool less. But then, if they're viable, you need to make sure that they restructure the loans to make them basically turn them from non-performing into performing. I mean, that's an art in itself. But I've seen it happen, and I had the pleasure. I mean, it wasn't the great circumstances during the crisis, but we did those things, and I feel I benefited from looking inside that box, basically, the workings of the banking system, the workings of the central bank itself. Thank you.
That's absolutely precious. Thanks so much for taking the discussion into this, and I think is really addresses some of the theory issues that colleagues had raised. The AK model is brilliant. The work of Philip Agion in that adds into that dimension, which is purely theoretical. I also like the way you have taken an excursion into policy dimension, because yes, you kind of hammered it so well. At the end of the day, it's what the policymakers can actually take from this empirical work and in practice and engage with the trying to make finance work for increasing growth and altering the growth profile. And a good distinction you made between macro and micro. Yeah, some of that work one needs to go at the micro level to distill some of the interpretation. Okay, I just want to see. Let me see. I see a note in the chat. No, that's no leaving. Okay. Very well done. Thanks indeed. Panicos, you've delivered an exciting, engaging seminar. Able to explain issues so clearly. We are very much honored to have you here at this seminar. and also to have you as a contributor to the inclusive finance project, which you have done, excellently. Let me also thank all of you participants for making the time to be here and to engage in this discussion. Nothing would happen without your participation and your availability. Now, this happens to be the last seminar in term one before we go for the Christmas and New Year break. We will be coming back to resume the seminars for term 2 of the academic year, and we'll be having an exciting presentation from one of the people that was asking questions here, Professor Pascalis Caramosino from SOAS, who will be speaking about fiscal consolidation, balance sheet recession, interest rates, and bank lending. In fact, these are also issues in which Panicos is an expert, especially from his role as central bank governor, where he had to interact with what the central bank is doing and so forth. But so it's we have a smooth transition into some of these issues, and Pascal will be sharing with us his presentations on the 13th of January next year. Until then, let me have the pleasure of wishing you a very restful and enjoyable festive period ahead. Thank you very much. Bye-bye.